Great. Thank you very much, Rick. Thank you for giving me the opportunity to speak with the group. I think what we're working on is very interesting conceptually, so I thought it was good to share. I think this was on the back of some other comments that you had made with the network with regards to tokenization in general. I will start by just a quick background on my side. I'm the president and managing partner at Wave Financial. We're a registered investment advisor here in California. So I am actually licensed to talk about financial products and so forth. I'm licensed with the SEC. Our firm is registered with California. We've been audited before. So, all clean and all that great stuff. So all of that, puts us in a good spot. And the reason I highlight that is because I think the blockchain and crypto space has had a reputation of, a lot of people doing different things, and some of which were, not as, regulatory compliant as others. And when we started Wave Financial, about 2 years ago, we really wanted to go down that prim and proper path. The slight downside is obviously we have very large legal bills every month, but, hopefully we're kind of on the right side of these trades. Specific to the discussion is that, we've been looking at ways that, we can use blockchain and cryptocurrency technology for asset management, wealth management, and treasury management. And setting crypto aside, today's discussion will not be about crypto. We're not going to talk about cryptocurrency. This isn't a white paper in dreams and aspirations. Today, what we're going to talk about is actual tokenization, and more specifically, tokenization of hard assets and hard assets, for people to potentially invest in. And that's the focus we want to have today. So let me just talk through some of the things right now, and I'll try it again in just a bit. Kind of talk through the security tokenization landscape and the idea and so forth. The discussion right now is on potentially the use of blockchain technology for tokenization. And I think we'll start with the benefits of doing that. A lot of people have talked about blockchain and the use of blockchain as the next evolution in finance. And I'm going to skip what a blockchain is and so forth. We can have a separate discussion on that, or you can find YouTube videos on that. But basically, blockchain, we're just using the blockchain technologies, kind of distributed network setup and so forth, to run basically what is the cap table or the ownership table of hard assets and so forth. And we are now investing in hard assets and using that technology. It comes with two specific benefits to it, and there are many other smaller benefits, but the two main ones are, one, the efficiency of using the blockchain for this application, and the second is really the potential to create a liquid market on, which is the part that we are emphasizing on, we're stressing on. The blockchain technology in its current form is very good because it can use smart contract technology so that we could deliver dividends and so forth. So for example, we could set up a fund that we're paying out monthly dividends, quarterly dividends, or daily dividends that is very efficient to deliver. When I first started using the blockchain technology, I looked at my own experience as an asset manager previously. I used to run alternative investments at AllianceBernstein. And we actually had a product where we were delivering dividends on a quarterly basis. So when we switched over from quarterly to monthly, we had to add a lot of staff and we had to add a lot of administrative process to make that happen. Because of that, we were able to capture a lot of business, but there was a significant cost to going from quarterly to monthly. When I joined the blockchain space, I had spoken with people in this space and asked, how much does it cost to deliver a dividend on the blockchain? And people who are familiar with let me try the share screen once again. So people with, with the blockchain technology actually were very surprised I asked that, because they're able to deliver dividends basically on a live basis. I am doing a screen share. I hope everybody can see that.
Yes.
Great. Let me actually go to my presentation. So yeah, apologies for that. There were some technical glitches. So now the presentation is on, and kind of back to the discussion on tokenization of whiskey here. Oh, okay. Now. So let me kind of get into some of the information that I started talking about. I think to use the blockchain technology to do tokenization. I think it actually is easier to think about it when you break it down into the different pieces. And these are the pieces that we have. And these pieces actually, this presentation, or this part of the presentation, was a report that we had done for Tezos. We published this in January, so I'm happy to forward that presentation out to everybody if they're interested. Basically, we've broken the securitization market down to individual pieces to hopefully help people understand. There is really an issuance process to issue the tokens. There is a legal and compliance process to make sure that the offering is legal. There is the actual issuance and then the custody of the tokens once it's issued. There's an exchange for the trading of this. And then there is a life cycle management after the tokens are issued and so forth. Along with all of this, there is a distribution process for the sales of the tokens and of the funds. And the regulations are actually different country by country. And at the base of it all, typically these issuances are done on certain protocols. Wave Financial was a consultant to Tezos as they wanted to get into this business. So we advised them on how to navigate this whole landscape in order for their tokens to be, one of the many platforms that are available to be used by this infrastructure. In these slides, I'll work through these slides a bit quickly because of kind of the technical glitches. I'm running a little bit more short on time. There are a lot of people that are actually already starting down the tokenization process. All of these names you see are companies that have done a tokenization, have worked on having tokens out, separate from kind of Wave Financial on there, which is us. There are companies like Science and 22X and Spice VC and so forth that have created a token that is represents the ownership of their fund. It's currently listed. It's on an exchange that people can buy and basically trade. You see names like Franklin Templeton. Franklin Templeton actually has applied and is in the process of getting an approval to set up a money market fund, which is they run a lot of money market funds. They've set up a new money market fund which will have a token to it, which is a very interesting concept because it's almost like a stable coin but pays an interest due to the money market fund nature of it. I'll move on to some of the other providers. And once again, we'll share these slides afterwards so you can look at it in more detail. But there are quite a number of different platforms out there that can actually issue these tokens. Some of the famous ones are like Securitize and Vertalo and so forth. There are players like Start Engine that's more focused on the fundraising side, and they're using more of the Reg CF, which is an exemption to do smaller deals to a wider audience. Some of the other guys, which I was talking about before, are more down the Reg S, Reg D, which are more for accredited investors, but you can raise much larger sizes. And the Franklin Templeton deal, which is going through SEC right now, is going for a full public offering of that security, which in theory would be available to everyone with no size limits, but it does require an SEC approval. So, once the token is issued, the fun part, or the part that makes everything very interesting, is actually having the tokens be available, not only with a custodian, and I have a number of custodians listed here, but also with exchanges, which exchanges are able to do transactions on security tokens. The famous ones are the ones that are in operation right now in the US that are commonly known as Open Finance and T0. T0 is owned by Overstock.com. They've been trading their own token for a while now. They've recently listed the Aspen coin, which is a digital representation of fractional shares of ownership of the St. Regis Hotel actually in Aspen. Not only that, they have a number of other coins that they're starting to list, and we're in active conversation with them with regards to the various products that we have to be listed on their exchange. Those are the domestic US exchanges. In Europe, Arcax, which is a good partner of ours, they just actually announced yesterday that they got their license. So they're now officially operating a digital exchange in the UK that's able to list some of these. In Asia, our partner OSL, which we've done conferences with before, are applying for one in Hong Kong. The regulatory framework just came out late last year. And in Singapore, they've had a sandbox for about a year now. A number of people that we deal with, like iStocks and One Exchange, have actually gone through the sandbox and now are open for business. So it's a live and very vibrant market, and a lot of these markets globally are growing to be able to handle that. Um, so I think I was talking about a number of different features to it. Specifically to what we're doing, we're trying to make this more accessible rather than less. So what we're doing is we're trying to create a set of tokens that would represent ownership of a fund that would hold hard assets. That's probably the easiest way to understand, hard asset tokenization. And just to kind of move to a specific example of it, we've looked at taking hard assets and putting it on the blockchain over a number of things. Currently, there are a number of real estate deals that are available in the US that people have tokenized. For example, the St. Regis that I just mentioned. There are other hard assets that are also, people have looked at tokenizing. One of our partners here at the firm was previously another firm that had tokenized an apartment in Manhattan. People have looked at student housing, people have looked at fractional tokenization of cash flows of real estate, and so on and so forth. But I would say that in the US, real estate tokenization has really not caught on, because I think in the US, real estate investments are actually very democratized. There is a lot of access to real estate investments. For example, you can right now go, in your brokerage account and buy REITs, which gives you, access to cash flows of kind of buy and hold real estate projects. For, kind of accredited investors, they typically know other people who are in the real estate space. You can get a loan, buy real estate yourself, or you can also potentially invest with friends and family into projects and so forth. A lot of my acquaintances already have plenty of access to the real estate market, so they don't really feel a need to have a tokenized product for them. We also looked into all sorts of other things. We looked at Japanese racehorses. We've looked at art, which is more on the collectible space. We've looked at clean water. We've looked at carbon credits on the commodity side. And we've looked at many different assets that we thought could be interesting to tokenize. For the first project, we wanted something that's easy to understand and that has a good rate of return. So hopefully people have a positive experience on tokenization. So we decided to start tokenization using whiskey. It's a topic that people are happy to have a discussion on, even if they're not interested in investing. And it's something that is easy to understand from an investment perspective. So just a little bit about basics on the whiskey investment side, and I won't get into too much detail on this because I do want to focus on the tokenization. We're able to source a barrel of whiskey for less than $1,000, and including storage and so forth over 5 years and insurance, we're looking at roughly $1,000 a barrel of cost. In that 5 years, these barrels are typically worth $3,000 to $5,000 due to the increase of raw materials to an aged product. And this number is actually relatively conservatively estimated. We've actually had consultants in Kentucky who's done market research, and we're pretty comfortable with these numbers. This is a very attractive return profile, and this is a very stable return profile because, we have insurance on it. If there was a handling problem or if a warehouse burns down, the insurance actually covers that. And, warehouses do burn down. I think Jim Beam lost a warehouse last year or the year before. And, because these barrels are full of, over 50% alcohol, they just basically sat there and waited until the warehouse burned to the ground before they cleaned it up. It does happen, but it is covered by insurance, and it's something that, as a business model makes this very stable. Because of the stable return, we thought it would be very interesting to put it in a private equity fund format. So we basically set up a fund that would buy the whiskey. We would hold the whiskey while it increases in value. We would sell the whiskey at the end. That's a very generic way of describing most private equity funds and most VC funds. You buy an asset, you wait for the asset increase in value, and then you sell the asset. What's a little bit different here is, it's still similar to private equity and venture cap, but different from some of the other funds that you could have potentially seen, is that there's, pardon the pun, but there is no liquidity in the hard assets in that 5 years. There's no cash flow. if some investor was to say, I want to leave my investment, 1, 2, 3 years in, there's no way to give them that exit. This fund is not set up with an excess pool of cash to give that cash back to the investor when they want it. So the investors are, for the lack of a better way of saying, stuck with an investment for up to 5 years. This is where the tokenization component becomes very interesting. We are basically going to tokenize the fund. So the fund will, the ownership of the fund will be represented by tokens if the clients want. We have a section of investors that have said they don't want to invest, they don't want the tokens. They don't understand it. They don't want to deal with it. And they just want to be in the fund. And we allowed that. So we have people who are going to stay in the fund and people who are willing to take out, to hold their ownership in token format. For those people, the tokens become available for trading. We're going to list the tokens on some of the exchanges I mentioned previously, and the tokens will be available for people to potentially buy and sell. Now, obviously, there's no guarantee that there will be liquidity there, but we're creating a market that makes it available for people to buy and sell. Over the longer term, as we start liquidating some of these barrels, when we do have excess cash, in our fund, we can actually go and buy those tokens to return capital to clients. That's one way to do it. The other way to think about it is similar to a stock buyback, where we're going in and to take out the representation of ownership, reduce the ownership amount, and therefore increase the value of the portfolio itself. And we would do that if the tokens were traded below the values of the barrels. To be very clear, our tokenization project is not about having one token linked to one barrel, because I don't want to be the person that decides on which barrels we sold and which barrels we didn't sell. I don't want to create a queue of people who want to get their barrels earlier versus later. They would have slightly different values. It becomes very complicated. Every token is fractionally owning every single barrel in the fund. You're basically a fractional owner of the whole fund. So as we sell, the fund slowly shifts from 100% barrels to 100% cash, and the token owners will be fractionally owning that. Don't need to get into a lot of these details too much. This is our estimate of the value of the barrels that would go up. And this estimate, basically, multiplied by the number of barrels we hold, is the estimate of the net asset value of our fund. One of the things that we really liked for Whiskey with regards to this product is that when we tokenize a fund, we're going to provide NAV of the fund. But if you, to get the right NAV, what we're able to do is from probably year 2 on, we're able to sell a few barrels out of our total inventory, and we can establish to a certain extent what that value is. If we set up a fund where we held one piece of Picasso or something to that effect, it would be very hard to sell that Picasso and get an NAV, that value, if it doesn't trade. So from our perspective, it makes a lot of sense to start the project with a barrel, because it's fractionalized and we're able to sell bits and pieces of it to try to get the best value from an NAV perspective. We will make that NAV available to investors so people know where the theoretical value of these tokens are. People may trade above or below that theoretical value, and really a supply and demand discussion. But overall, that's one way to establish the intrinsic value of these tokens. And this is what's different between what we're doing and what you typically have in the cryptocurrency space, where there is, there's not a lot of fundamentals with regards to the valuation of cryptocurrencies. Whereas in this case, there is a very distinct, financial factor that would indicate the fundamental value of it, which is the value of the barrels of whiskey. So I want to talk about I think I've mentioned some of these points already, but basically by tokenizing it, we're potentially able to provide liquidity to these tokens. These tokens in theory could be traded 24/7. Some exchanges don't operate 24/7, but most token exchanges operate 24/7. So there is 24/7 trading. There's transparency in terms of the token transactions being on the blockchain. So it's quite visible as to whether tokens have traded hands or not. The tokens are asset backed, like I mentioned before, and it's a single investment across the whole fund, across the whole barrel. So it makes it very convenient for clients to get access to this investment class. And be able to have exposure to this investment. So I think I've covered most of these points already. So yeah, I've also introduced our firm already. So I think I'm going to skip through some of these. So my apologies. I think because of the technical glitches, I've actually kind of blown through my presentation relatively early. Uh, Rick, I don't know if it makes sense to actually open it up for Q&A and maybe we can talk about some specific details that people may be interested in. I'm happy to go back and cover more from a regulatory perspective or more on the kind of the platforms and so forth and what we're looking at in terms of US versus non-US regulations. I don't know if you think that that would be an interesting point to discuss.
I think it would be great. I want to thank you, Ben. I've seen a lot of presentations about tokenized funds, and this was one of the more succinct and direct ones that I've had the pleasure of listening to. So I'm going to open up the floor. People hit me in chat, and we'll take your questions in queue.
Yes, and I think at Rick's suggestion, we're offering a bottle of whiskey for the best question through this. And the whiskey that we are offering is actually the whiskey that we are buying in barrel format. I actually just put an order in yesterday and paid money for 1,000 barrels of this whiskey. It's from a distiller called Wilderness Trail. They're based in Kentucky. I've been out there a number of times, and they're great people. It's a it's a boutique firm that's now turning Bulge Bracket, and we'll be offering a bottle of their whiskey, to the best question. And for jurisdictions that we can't deliver whiskey to because we're in COVID, we'll send you an Amazon gift card equivalent.
Okay, well, that's good news. You can't really lose, so ask some questions. Adam has a question. First, he says, "Thanks, Ben. That was great." And it was. What assets do you think will be the first to be tokenized at scale, on a large scale?
So this is an interesting question, and I think this question changes between US versus non-US. In non-US, I think real estate will be the winner. Non-US investors, and now let's call it Asian investors, I think have great interest in real estate. I don't know if it's genetic or not. My mom's a real estate agent. Everybody I know is in some form in the real estate space. I spend a lot of time in Asia, and everybody I speak to has some real estate exposure of some sort. They're also not shy about blockchain cryptocurrencies. It's funny, for example, China has banned Bitcoin, but is very big on blockchain technology. They're pushing that down. They're doing their own digital currencies and so forth. And that, kind of positive openness to exploring new technologies is generally true across, all the countries, even more conservative countries like Japan and so forth. They're really pushing towards, real estate tokenization and so forth. So I would say internationally, real estate will probably be the first. It's chunky, investments that have a long holding period that makes sense to be fractionalized and also, traded and so forth. In the US, I think that's a harder question. I don't actually know. I think we're trying different things. I personally am trying the whiskey route just because I think it's got a little bit of a novelty factor. We can talk about it. There have previously been, high-end collectibles in fund format done. I'm hearing a lot of art being done in the high net worth space. People are doing art. So maybe that's a space that's interesting. I've avoided tokenization of collectibles as a first cut because I'm a little bit concerned that, the collectible space is difficult. It's about buying expensive things and hoping it becomes even more expensive, right? The intrinsic value comes from more people wanting it for longer and the scarcity and so on and so forth. It's difficult to assess the NAV and intrinsic value of that. Whereas, whiskey is more commoditized.
Talk a little bit about collectibles versus commodities. I mean, we've had that conversation before.
Sure, yeah. So in terms of collectibles, I mean, we looked at potentially tokenizing a Picasso. Our founder, our CEO, actually, David Seymour, actually knows someone who owns some Picassos, I think about $600 million worth. And we were saying, hey, can we tokenize a portion of that so people can enjoy the returns on exotic art or high-end art. High-end art typically appreciates 10 to 20% a year. It depends on markets. And that return is relatively stable. So it does make sense from an investment perspective to hold that. But from a collectibles perspective, just because you own $100 worth of Picasso, that Picasso is not showing up at your house for you to decorate your walls anytime. So the collectibles really just becomes a pure financial instrument. It's not very interesting. We've heard people wanting to do exotic cars. If I don't get to drive those, I'm not interested in investing. So there's a usage component that is hard to do from a collectibles perspective. It's purely from a value, a value gain perspective. And once again, like I mentioned before, with a Picasso, you can't sell a corner of Picasso to figure out the value of the rest of the Picasso. It's an all or nothing sale. Without a sale, it's anybody's guess as to what that value is. You can look at other sales as a comp and as a comparison, similar to real estate, but it's very hard to assess. For the more commoditized things, like what we're doing in terms of whiskey barrels, you can sell 1, 2, 10 barrels and assess the value of the rest of the inventory. It's not 100% accurate, but it is a much better approximation of what the value of the holdings are. So being in the commodity space gives you better NAV calculations, gives you a better feel for things, and it's more purely on investments, less on an emotional aspect and a collectible aspect.
Okay, Adam has another question. What approach do you think would be best for digital assets like music rights? Now that's a very specialized place to be. Music rights, that those are legal issues and all kinds of other issues. So I don't know if you can answer that, but if you can, that's great.
Sure, I will address it in a more general sense. I think there are
IP
people in our
maybe?
firm who are, yeah, I think there are people in our firm that are much more experienced to address specifically to music. I'll talk about it on a more general basis. I think the discussion is simply that music rights, in theory, has a stream of income attached to it. Some have more streams, some have less. The more popular ones obviously have more, and the less popular ones have less. So that stream of income can be tokenized. That is fundamentally the discussion. We've had, Spencer Dinwiddie, tokenize his pay from the NBA. We've had other people look at, tokenizing a stream of just really income from. So the tokenization of a stream of income can be done. From that perspective, IP can be tokenized. I think the difficulty comes really more from the distribution channels of that revenue. I'm less familiar, so I'm going to stop talking about it soon. But basically, the distribution channels all have to flow that cash flow back. And I'm not necessarily sure that they're properly credited. I invest with a group out in Asia, and they've been looking at streaming rights in China, for example. It's a big lucrative market. But a lot of times they don't know how much each song is played or each video is played. And the streaming platforms are just kind of writing a check. It's roughly, $50 million. Here's a check, go away, don't call me type of thing. It's actually, that infrastructure is still very nascent. I think in the US it's a lot better. But even then, I think, being able to credit that and having that credit become a solid, a form of cash flow stream to then be tokenized would actually probably be the bottleneck. Once that's done, I think it's a very interesting discussion. I would say that, people can go out and tokenize that and so forth. The one other thing I want to mention just kind of on that stream of discussion is there's an expectation of a lot of things being tokenized, and then there's an expectation of a lot of people wanting liquidity thereafter. That market is still very, very nascent. I think on a primary basis, you can go and buy, whiskey barrels, you can buy, streaming rights, Spencer's contract and so forth, all as streams of income. The moment you want to sell that token to somebody else in a market, there needs to be a buyer there. And that buyer isn't quite there yet. It's, for the traditional real estate spaces there, we're starting to see that a little bit in real estate tokens, but it's still extremely nascent. I think there are plenty of primary buyers because they're interested, they like the payout. There's not a lot of secondary buyers as of today. And until that grows, I think, this will slowly grow until that part of it is a lot stronger.
Fair enough. Okay, from Martin, what will be, in your view, the primary blockchains used for tokenization of assets? I think that's a great question.
So tokenization of assets can be done using just paperwork. Like you get enough lawyers, you write enough contracts, you can get it done. You don't actually need you don't need the blockchain, you don't need tokens. You can right now manually transfer your ownership of real estate with each other with no blockchain. You, in theory, can have a private fund that you sell to your buddy, and you have a lawyer in the middle that signs off on it, and the fund signs off on it, you're done. But it's a very cumbersome process. The whole point of using blockchain is so that the ownership is represented by a digital instrument, and that digital instrument can be easily transferred to another person that's in a pool or a whitelisted area. So that is the part that's very hard work for people like us. We have to go figure that out, but it's very easy for the users once they have the token. We are actually, when we list our tokens onto an exchange, we have to make sure that the exchange will follow all the rules and compliance and so forth. And they will have a pool of investors that is pre-qualified to be able to buy these products. Those things are basically set up ahead of time so that when the client wants to trade, they can come into a market, they know that there are people who are qualified to be able to make that transaction. So we're automating that, and all of that automation depends on putting the ownership on a blockchain, and that's kind of the key point to the usage of blockchain. And
So,
it's a very valid use of blockchain, which I think is great.
so Ben, which blockchain do you use?
So that is a good question. I think there are a few blockchains that are a little more focused towards security tokens. Like I mentioned before, we're a consultant to Tezos. Most of the tokenization right now are actually done on ERC20, which is the Ethereum blockchain. And the reason for that is because the Ethereum blockchain has been around for a while. They're big enough. There are a lot of developers that develop on the Ethereum blockchain. So it's an easier implementation. It's not quite optimized. As you probably heard in the news, somebody built a collectible digital crypto cat system called CryptoKitties, and that kind of slowed down the Ethereum network because people are trading cats a lot. So it's from that perspective, it wasn't originally designed for that. It was designed originally as a generic programmable contract chain that may not have the throughput. So a number of networks are stepping up to say they want to do that. Tezos has said that. A few other blockchains have said that. For our whiskey project, we decided to partner up with NEM, which is one of the older blockchains that's been around, because they will also want to get into the security token space. Due to the fact that they are actually up and running and available in a number of countries and are well respected, we thought it'd be good to partner with them. As an example, Japan has not approved a new token to be listed on their crypto exchanges in, I want to say, 2 years. So, so NEM is one of the tokens that actually was listed from before. So it makes it easier to work in certain countries because the blockchain or the protocol is, let's call it, more well respected or more well accepted.
So NEM is out of Singapore, right?
Well, they're global. We're speaking actually to their guys out of the UK, and our issuance platform, we're working with them on that. It's a different company that they're working with also, but that company is out of Singapore. So.
Okay, so let me go to Jones's question. Jones, I guess you're in Switzerland now. Last time I saw you was in Paris. But thanks, Ben. I see a lot of tokenization happening in Switzerland and other EEA countries. I'm just wondering why you chose US as the jurisdiction for this project. Part two, secondly, since the tokens will be exchange traded, how would you control the price to ensure price stability vis-a-vis off exchange price?
Okay, those are great questions. If you don't mind, I'll answer the second. Actually, no, I'll answer the first question first. We're doing American whiskey, so it's kind of hard to do it like outside of America. So our holding company is in the US. We buy the whiskey's in the US. We have to pay US taxes anyway. We might as well do it in the US. With that said, we have an offshore feeder for non-US clients to invest in it. So, it's an efficient setup. I know some people avoid the US because the regulatory burdens are high, but me being a US citizen, being in the US, I am comfortable that if it works in the US, it kind of works globally. There is a general kind of accepted, I hope it continues, but there's a general accepted, feel for U.S. investment products being, more solid, being more well-regulated and so forth. The regulation is a pain in the ass, but at the same time, it does give investors a bit of comfort in having it being in the U.S. And, kind of back to the fact that it's American whiskey. So being in the U.S. was a natural choice. Specifically to Tokens and price and price support or price control. That's a tricky discussion. I'll answer that in a number of parts. The first thing is, I think in the cryptocurrency space, there was a lot of freedom protocols have taken with regards to controlling price, to market making, and so forth. Because they were not regulated as securities, the market making process was also not regulated. So it was done in a very free form, a very kind of liberal way. And, I'm not necessarily sure that, makes sense. So I actually am not sure if it's legal if they were considered securities to have been to do what they have to do. In the security token space, I believe that some of that support can be done. There are legal frameworks around, for example, an investment bank supporting the stock price of an IPO after IPO. There are procedures that can be done that's official and not considered manipulation of the market. I would love for those rules to apply also to our product. They currently do not, because we're talking about over a longer period of time rather than just the initial process. And for US regulations, we're actually not allowed to freely trade our tokens in both directions because we're the issuer, we're the primary source of these products. We, in theory, also have inside information about it and so on and so forth. So we're not going to actively do that. With that said, we are allowed to buy back, and therefore we do plan on buying back if the token prices drop significantly below the value of where we think the portfolio should be. If we can liquidate barrels at $2,000-$3,000 and the tokens are trading at $1,000 a barrel equivalent, it makes a lot of sense for our existing investors for us to go buy back those inventory. And we will also be publishing the value of those tokens so that people understand that if they do transact at 1,000, that they're transacting below what we think the value is. So I'm trying to close that gap by, one, giving people information, and two, supporting it on the low end to make sure that it doesn't drop through the floor. The hard asset sorry, just one last thing, apologies. The hard asset tokenization business really, my interest in it really comes from the fact that it is backed by hard assets, and therefore it's not designed to be extremely volatile. Like, it's supposed to stay within a certain bound. For example, if you look at stable coins linked to the dollar, it doesn't move very far away from the dollar. It's not designed to move away from the dollar. It's designed to be pegged to a certain value. You can think about that in a similar way with hard asset tokenization funds, where the token value is supposed to be near the hard asset. Now, some punters may not find that interesting, but from my perspective, that's the right way to represent ownership of these hard assets.
Okay, great. Thank you for that. Michelle has a question.
Sure.
Do you think tokenization of commodities in Africa could scale rapidly? Let's say
that's actually a very interesting question, partially because I'm actually working on consulting a project in Africa for tokenization of commodities and actually the rights to mine and take out minerals from the ground. I think there are, not to get into too much detail, I used to run the commodities business for Bank of America Merrill Lynch across Asia. So I have kind of knowledge in the commodity space. I'm very comfortable with it. There are a number of layers that can be done in that space. And I think that that's a very interesting discussion. One of the African countries is actually asking for our help to create a blockchain system to make sure that the mining and the mining rights and the commodity that is mined is properly tracked so that they can show the world that it's a clean, open discussion. There's no government corruption. People are not running off with the money versus the commodities. It also makes it's not just for them, it's also for the international players to know that when they buy mining rights, nobody is cheating, nobody else is getting an extra this and that. So, having a blockchain system, leaving the books open, makes it much easier for a fair playground to be built. And I commend them for their interest in doing that. They also want to build an exchange to trade that in their market, and we're supporting that whole process. So We believe that that works. We would like to do it in a country first, and we would like to scale that out to other countries also. I know of some of our partners on the protocol space have worked with other countries in Africa. I probably mentioned the country. I know, our partner protocol, Cardano, which we work closely with, we run an ecosystem fund for them. They actually have projects in Ethiopia with regards to microfinance, with regards to commodities, and so on and so forth. So I believe that that will come, and it could scale pretty rapidly, simply from the fact that um, it's an adaptation of a new system as opposed to retrofitting the existing systems, and sometimes that's faster. Just as a generic example, Indonesia went to cellular pretty easily because they never had traditional landline phones. It's not about replacement of an existing technology, it's going from no phone to cell phone. It just made a lot of sense for them. Also, they're on islands as opposed to a single landmass, so maybe that helped also. But basically, the adopting to a new technology from scratch sometimes is actually easier than trying to replace existing technology and pushing against incumbent players who don't want that upgrade.
Absolutely, that leapfrog effect that we hear so much about. We should actually, you, Michelle, and I should speak offline at some point about that.
Sure, it's great.
We're gonna go to Adam. Has a last question here. That's a personal question, it looks like. Outside of securities tokenization, what excites you most in the crypto space?
So right now, I find crypto to be very exciting in finance in general, and at the same time, I am very scared right now in finance in very general. So I'll talk about that a little bit. It's completely separate from the hard asset tokenization discussion. Right now, I believe that crypto brings a lot of different capabilities to payments, to investments, to finance from a technology perspective, and having new tools. And to say it from my own personal view, it's kind of having new Lego blocks to play with. I'm very excited about that. That's why I came into the space. I did 15 years of traditional finance, both buy and sell side, and I'm kind of looking for new Lego pieces to play with. So when I jumped in the rabbit hole of blockchain cryptocurrencies, I went right for it. Ended up co-founding Wave Financial, and that's what I want to do. At the same time, crypto seems to get itself into trouble a lot, kind of on a repeated basis. One is, the whole crypto ICO craze to raise money from individuals, some of which are not not understanding what they're investing in. That was, I would call it somewhat of a fiasco. It made some people very rich. It made some people not very rich. There were a lot of scams and all of that also, and the whole thing not being regulated was a little bit uncomfortable for me. And I've had a securities license in 4 or 5 different countries over the past decade, and I just like it being a little more regulated. The second thing is, which is a more recent phenomenon, there's a big discussion about DeFi and yield farming, and people putting a deposit at some platform, being able to borrow money on it, and then taking that money and going back and borrow that money using that new thing as a collateral and leveraging themselves up to make higher yield. And you can do that in the traditional space. People don't, because it's dangerous. It's you don't re-leverage and re-leverage and re-leverage again on your collateral, because when on leverage, when it doesn't work well, you get stopped out very, very quickly. In the crypto space, the stop out is also not negotiated. A lot of times it's automatic liquidation. So when you get liquidated, you're done. And it isn't the bank calling you, hey, let's work out the loan. It's, here's what's left of your collateral after we liquidated it. You owe us money, or we've cleared you out. So it's I think it's a little bit dangerous. I think people are not quite understanding the DeFi space. A lot of the yields that are quoted are that people saying they're getting also comes from a rise in the value of the DeFi tokens themselves. So I wouldn't go as far as calling it a Ponzi scheme, but you are really feeding into your own network for that value. And that stops working when less people feed into that network, right? Which unfortunately is similar to how a Ponzi scheme works, right? So that is a concern for me from the DeFi space. I hate to say it, and I think people will hate me for this, but I think it probably would be good if there were some regulations to come in and to try to clean that up a little bit. With that said, I do think that there's some very interesting things. I think a number of funds like, Franklin Templeton, like I mentioned before, they're running a money market fund that's tokenized. So you can have US dollar tokens that pay you a dividend daily. I thought that that was really cool, very interesting. It's public information. They filed it with SEC. Everything I'm talking about is public information. Their token is supposed to, they're not out yet, but their token basically pays you a yield as a money market fund would. And so you can keep these tokens like dollars in your wallet that increases in value every night because of the interest rate component. So as opposed to keeping the dollars at the bank, you are now able to earn interest rate on your dollars sitting in your wallet, for example. They're digital wallets, but so conceptually that's interesting to me, right? There are staking platforms. So protocols are now trying to give back some of the value of people using their blockchain. And that's interesting too. So people who are paying to use, you pay gas on Ethereum, you pay for network usage. Somebody's getting that value, and now they're pushing some of that value back towards the token holders in terms of staking, in terms of what they call baking, which is just staking, but for different protocols. I think that's interesting. I think the staking aspect also forces people to vote so that they're involved in governance. I'm hoping that that gets more people to vote. It's not about voting one way or the other, but it gets people to be more involved in the protocol, which I think in general is a good thing. Unfortunately, I think that specific angle will deteriorate into kind of right now institutional voting, where all the institutions vote one way or the other. So maybe that won't be such a big thing. But the finance aspect is very interesting for me, but the DeFi one, due to lack of regulation, is a little bit scary. So, let me stop my ramble there, but I do find the finance part of crypto very exciting.
Okay, we have Anish would like to know, well, he came a little bit late, so he missed your description of your model, but I'm sure he'd like to do that. You guys can do that on the network at a different time. But what he'd like to do at this point is how you prove proof of existence of the assets.
So the proof of existence is actually not done on the blockchain. It's actually done off of the blockchain. We basically have we hire staff to go audit the whiskey. The whiskey sits at the warehouse. So we're buying from, like I mentioned before, we buy from Wilderness Trail. They make our whiskey barrels. I just bought 1,000 barrels yesterday. I sent the money in. They're going to make 1,000 barrels of our whiskey next month. And it'll be a wheated bourbon, basically aged next month. And from that point forward, it'll sit in their warehouse. It's going to age. We are going to that warehouse, going to check to make sure that that's there. We'll probably do that on a quarterly basis. We'll report that to our fund administrator. Our fund administrator will account for that. And our fund administrator, and we will also submit all that information to our auditor. We have an auditor that will audit our inventory and so forth on an annual basis. And they will also, provide tax filings and things of that nature, and a certification of us being audited, annually to our investors. So that's an off-chain process, but it's a very good question. I think that's a question everybody should ask for every hard asset tokenization project people get on. There is a dreams and aspirations over the long term to be able to have blockchain be attached to every single barrel, and so you can do on-chain tracking. But not to get into too much details, then the question comes down to, how do you identify each barrel and be on the chain, and do you barcode them, and how do you know that that barcode can't be moved? So there is a chain of a question that you can go down and get into minutia, and we've decided not to explore that right now. But we will, but that is, a development in the supply chain space that is, we keep an eye out on that.
Okay, so I don't see any more questions. Are there any more? Now's the time, actually, to type them in so I can read them to Ben. I'll give a couple of minutes for that to happen. Really happy to see some of our members from all over the world here. Anish in London, Jones in London, Michelle, I don't know where you are, probably London or Paris, or who knows where you are. And Monica, I guess maybe here in New York. But anyway, the most important thing is that I thought it was a great information session. I love the fund. I'm not licensed to sell the fund. Oh, Michelle's in London, she says. So we have the UK-US connection today. And if there are no other questions, then Ben, any parting words?
Yeah, so just kind of, not to get too far into it, but just a quick pitch. We are raising money for the Whiskey Fund. If there's anybody that has any interest, please feel free to reach out to me. And for people just in general that want to learn more about what I'm doing, I'm happy to, talk about it in much more detail. So feel free to reach out to me on the network. I'm happy to chat. I'm available there. And I think, it's an interesting topic, and it's something that I've spent the past few years focused on, and look forward to being of value to everybody on the network.
That sounds great. Thanks, Ben. Really informative. Excellent job. Excellent fund. And we look forward to working closely with you moving forward.
Great. Thank you very much.
Absolutely. Thanks, guys.
Thank you.